This week, we are live talking about the Austin market, statistics, what's going on, and we are going to put the real in what it means to borrow money in today's day and age with the one and only Mr. Mark Koretsky. Welcome.
Thank you so much. Happy week of Thanksgiving.
As we head into Thanksgiving, we want to talk about what we're thankful for. And before Black Friday gets here, there's some deals to be had, it seems. Mark, rates are down.
Rates are down. There's a little bit more inventory. There's a little bit more options. There's a little bit more winning going around. It's great.
It really is. With that said, today we're going to do a quick snapshot at what's happening in Austin, and then we're going to jump into the real cost of borrowing right now for real estate. And I guess it's, for lack of a better term, maybe like a 5-part that we're going to do that's going to lead into 2-1 buy down and 3-2-1 buy down. Before we go on, what are you thankful for?
I am thankful for you, Jennifer. I'm thankful for everybody that I've been able to touch and impact this year. I think that's what it's all about. There's a lot of people. That's the main thing for me, is just the people in my life, my community.
Love that. Well, I'm grateful for you too, Mark. There's no question about that. And I'm going to go with health. Everything else will fall into place. Health is number one as we come off a time where globally we've been in a position that now seems to have turned around. And for that, I am hugely grateful.
Amen to that.
Amen. All right. So let's take a look at where we're at. Austin had 770 new listings since last week. And here's what's interesting. This is the first week in almost 2 months where we're actually below 10,000 homes for sale. So I think that's kind of interesting. And what that actually looks like is we had 152 price increases in the past week. The week before that, we only had 115 price increases. So it's interesting to see kind of where the market is going, how it's playing out. And when we look at price decreases, last week we had 1,668, and then this past week we only had 1,413. So 250 some odd less decreases in prices. So there seems to be some stability in there. And we saw 819 homes go under contract, which is up significantly from the week prior by a good 50 houses more went under contract. So we're moving and grooving here in Austin, Texas.
And as I was saying my opening line, I was like, wait, no, there isn't. And so you bring up a really good point, and it's something that I'll have a presentation for us next week on this exact point. But there is just so much seasonality to real estate and inventory levels. And so every year in the spring, we see an increase, and then we see a plateau in inventory, and then it comes down. And every year for the last 10 years, the peak of inventory doesn't reach last year's peak. And so we're actually seeing less inventory in the macro, even though we've seen a really quick increase in the available inventory over the last 12 months. That's just because we were at such historic lows.
Yep. What we've done every week is look at where those price decreases have actually come down, because I think that's a really important aspect when you are talking to people and you are in a particular price bracket when you are shopping. And so I always like to chat that up with you. So here's where we're at. When we look at houses under $500,000, there were 675 homes that had price decreases. Now, when you ask me what that means, let me tell you, that's down by a third, because last week at this time, we had 929 houses under $500,000 with price decreases. That's significant.
And a lot of it, I have a feeling, has to do with the cost of borrowing. And so we'll come back to that.
Yes. Awesome. In some ways, we're status quo between 500,000 and 749,000. We're about 100 houses again less than we were the week before. And where we really found the stability and the sweet spot and everything staying the same are houses that were between 750 and 999,000. Last week, we had 165 houses that dropped. This week, we had 140. So that was the kind of the space for people who are out shopping, a significant number of people who are out shopping. We're finding stability in that price point.
When somebody's buying a house, they're not looking at the overall purchase price, right? They're looking at what is it going to take out of pocket per month? What's it
Yep.
going to take to get in, right?
Yep.
And so over the last 18 months, we've seen that cost, both out of pocket and monthly payment, having gone up and up and up. And over the
Mm-hmm.
last 2.5 weeks, we've actually seen that cost to borrow and that those out of pockets and those monthly payments actually come down a little bit. And so
Mm-hmm.
we see the activity pick up. We see more people coming to an agreement. And at the end of the day, I think really what's going on right now is I think it's really we're seeing a normalization of these
Mm-hmm.
higher rates, right? Like the initial sticker shock that we all felt, it's a thing of yesterday. And the reality is it's easing a little bit, and we see the light at the end of the tunnel.
Mm-hmm.
But right now, it's a lot of buyers are sitting on the sidelines, and a lot of buyers are using that as their added incentive for them to actually go out and be a buyer today.
You're seeing all sorts of incentives going on when it comes to builders and when it comes to buyers and sellers, and which part of the financial equation everybody's coming to the market with. Because in our contracts here in Austin, there are many levers where I can change numbers for clients, and that affects overall where money is spent, if you will, before a house closes and then after a house closes. And then you can do the same thing. And yours is the biggest part of that impact.
It's maximizing the efficiency of money, right? And
Always.
and that's really where I love to get like all nerdy and like just dive right into the numbers. I don't know if you want to do that already, but at the end of the day, I think what really gives me the fuel and the passion is helping people save money and making sure that they do it and actually get into debt responsibly and do it in the best way for them.
Let's break it down. So, the first thing we want to talk about, Mark, for sure, is that when we go to qualify for a mortgage, there's the rate that you qualify for as a buyer, where there are no points and no buy down. Let's talk about that first.
A lot of people complicate this to no end. And really, I pride myself on just being able to simplify and just kind of translate mortgage to English. So it's really simple. Let's say a buyer is buying, right? They're going to have a down payment.
Yep.
They're going to have closing costs, whether they like it or not. And so what you're referring to is what rate is somebody able to get where they're not paying additional money beyond that down payment and closing
Mm-hmm.
costs to get
Yep.
that rate. That's what we call in the street par, meaning you're not paying points. The idea with points, and it's something that for every buyer can work out over time, you're paying additional money at closing to get a
Mm-hmm.
lower interest rate. The,
Okay.
in reality, a buyer can also do the opposite. They can take a relatively higher rate. The lender will give them money towards their closing costs. And so either way we look at it, we're looking at a trade-off. A lower rate means a lower payment, but it's going to be more out of pocket versus a higher rate where the lender is giving you money towards closing costs. It's going to be a relatively higher payment, but less out of pocket. And
And
so
we're
the
going to
idea is what makes sense for the buyer.
we're going to break those down for you folks, so stick with us as we do that. So the second thing is what we call, you pay your money and then you have a rate buy down. And to your point, the trade-off is you have a lower rate, however there's more out of pocket at the jump. Share a little bit about that with us.
Well, so because of that, it's not for everybody, right? If it's going to take more money than
Cash.
somebody has the capacity to do, then it doesn't really, even though it's an option, it's not an option that we can really leverage, right? The traditional way of going about getting that lower rate is what we call paying points. And
Mm-hmm.
that's really what that means is it's a permanent buy down of that rate.
Yep.
And so it's a one-time cost at closing. And the difficulty and really what my biggest drawback of paying points is it's an arbitrary number out of pocket for an arbitrary number in payment reduction. It comes down to how much time is it going to take for that out of pocket increase, that how long is it going to take for you to regroup and recover that payment decrease that you're experiencing.
You've got charts that draw that up for clients.
Right,
So that's the
right.
good news, is going in, it's not some nebulous thing. It's based on what we know today at these rates. If nothing were to change, here's your break even. We all know that you get to change your rate. And so getting to that break even can
Yeah.
come sooner for sure, or it can come later depending on what's going on in the market.
Well, and so you bring up a great point, right? We're talking about, for the most part, 30-year mortgages, 30-year
Yep.
fixed mortgages. And so in reality, most homeowners don't stay in their mortgage more than 5 years, and that's because they really don't stay in their home more than 5 years. Obviously, it depends on the demographics and kind of where you are in your age. But at the end of the day, when it comes to America, that's really what we're looking at. And so, like you said, it'll pay off. The question is how long, right? And so the only amount of time that matters is the amount of time that it matters for you, the client. And so something that we're doing a lot more of, because with the permanent buy down, it's a one-time cost and then it's gone, right?
Mm-hmm.
And so what we're seeing in the industry today, the likelihood that we're going to have lower market rates in the near future is much higher than that we're going to have higher rates in the near future. And so whatever money somebody is paying in a permanent buy down, if and when it comes down to refinancing in the short term, whatever money they pay at closing, that money's gone, right? And so when you go to do a refinance, you're going to have additional closing costs again. And so you really want to maximize the cost and maximize your money in general, right? And so what we're doing a lot of is the temporary buy down. The reason why I really like the temporary buy down is it's a dollar for dollar decrease in the monthly payment. So there's a number of different temporary buy down options. Somebody can do a 1% buy down for a year. There's a 2-1 buy down where it's a 2% decrease in the rate for the first year, followed by a 1% decrease in the rate the second year. And what we rolled out today as of the 21st is a 3-2-1 buy down. And so for that example, whatever the fixed rate is for the first 12 months, the rate that somebody is paying is going to be 3% below that fixed rate. That second year, it's 2% less. And that third year, it's 1% less. The idea here is whatever that payment decrease is, that's what somebody is paying at closing. And so it takes out the guesswork. It's a dollar for dollar decrease, right? And what we're seeing a lot of right now, especially with the contracts that are getting executed, is a lot of the time the seller is actually chipping in to help pay for the buy down, as opposed to the buyer coming out of pocket for it entirely, whether it's partial contribution or full payment by the seller. A lot of the times what we're seeing is that actually is exponentially better for the buyer to get that credit as opposed to getting a price reduction. And so that also probably goes to show you some of the reason why we're actually seeing less price reductions and more credits being offered.
Awesome. So where we were though, just going back, we had talked about the pay money down to buy down the rate, and the trade-off is a lower rate and out of pocket. Let's talk about the third thing, Mark. That's when you have a higher rate and then the lender gives money at closing. How's that advantageous to a buyer?
Nobody wants to pay and nobody should pay more than they have to, right? And so again, it's always a measurement over time. And so for somebody to take a higher rate, they're taking a relatively higher payment, but they're going to have less money owed at closing, right? And so a lot of the educated buyers that understand what's happening with the economy and that lower rates are to come, they're happy to pay a little bit more today, knowing that once it comes down to refinance, they're just going to be able to take advantage of the market rates at that point.
That sounds super smart.
There is no reason to pay more than you should.
Absolutely. So the higher rate option does sound like a really smart way to utilize your money when you know how it is effectively being utilized. I love that. All right, let's talk about number 4, which is permanent buy down and points, because we know that points are arbitrary.
So let's explain kind of what are points, right? And so it's a cost that somebody pays at closing. How much is it? 1 point is 1% of the loan amount.
Okay.
And so it really depends on both the purchase price and that loan amount, how much is 1 point, right? It doesn't have to be necessarily in 1% increments, but usually the most that somebody will really pay is 2%. I've seen other lenders charging more today. But so the idea is with points, it's that out-of-pocket cost, and then you get the payment down some. The question is how much, right? And that depends on how much are you getting as a payment reduction, And that is going to, again, depend on the rate and that loan amount. And so it's not a dollar for dollar amount anytime you're looking at points. It's not you pay $3,000 and you have $3,000 in payment reduction.
That makes total sense to me. So that's the permanent buy down. Now, what is this thing called the temporary buy down? Because temporary buy down has a payment reduction that the buyer or the seller can pay at closing. So break that down.
So there's a number of different buy down options. The most common right now is the 2-1 buy down. And so let's just say, for example, market rates right now around 6.5%, which they've come down, which we've talked about. Yes. And so if somebody's going to take advantage of a 2-1 buy down, if they're doing a fixed rate of 6.5%, the first year, the first 12 months, it's going to be 2% less. So they would be making payments as if their mortgage is a 4.5%. So that's going to be, several $100s a month in payment reduction, depending on what purchase price you're at. And so whatever that payment reduction is, that's what you pay at closing.
You need to be in a good cash position then in order to take advantage of that.
You do. And you mentioned a buyer can pay for it, but a seller can pay for it as well. And so right now we're seeing a lot more benefit for the buyer to get a credit from the seller as opposed to actually getting a lower purchase price. And so I've got an example for you based off of a $700,000 purchase price here in the DFW.
Let's do it.
And so I wanted to kind of look at, well, if a buyer is going to offer 25,000 less, so instead of 700, they offer 675. What are they actually looking at? And so we can look at that in a second. But I wanted to compare that to what are they actually looking at if they were to get an equivalent credit with that 25 grand. So with that 25 grand, we can do a number of different things for a buyer, including buying down the rate permanently or buying it down temporarily, or to your point earlier, the seller can pay for closing costs anytime. And so it could just be used just to pay for the closing costs themselves, right? And so here's what we're actually looking at. What we have is what I was showing you earlier. And so if somebody was to offer and do 20% down at a $700,000 purchase price, they're looking at a loan amount by about 560. With today's rates at about 6.5%, they're looking at a monthly payment of principal and interest. We're just going to talk about that for the time being. $3,540 versus if they offer 25 grand less, their loan amount starts out 20 grand less. And with that same rate, their monthly payment is a little bit lower, right? Less than $100.
It's actually a little more than $100, isn't it?
Yeah, it's less than $150.
Yeah. Well, $150 in after-tax dollars today, I'll tell you.
Correct. If we're just going to compare the two, then absolutely getting it for 25 grand less is advantageous for sure. And you know this about me, Jennifer, I'm an opportunity cost guy.
Heck yeah.
What I want to look at is what can we do with that same 25 grand?
Right.
And so something that the buyer can do is do a permanent buy down. And so with that option, they get a much lower rate. And with that, they get a much lower payment than the price reduction, right? However, what a buyer can do today, specifically with us, and I know there are a few lenders out there that are doing the 3-2-1 buy down, but they could actually get it down by 3%, meaning for their first year, their payment is based off of a 3.5%. Now that's a much bigger payment decrease, right? To me, that's much more significant. That's $1,000, right?
Right. Yep.
And so again, all of this matters, but it matters over time. And so I wanted to just show really that over time, the permanent buy down, which is this blue, it does make sense, but it's about year 5.5. And so for the first 5.5 years, this temporary buy down of 24,000 credit would be less than the price reduction. Permanent buy down costs less. However, it still doesn't actually make sense until we're at 5.5 years. right?
Yep.
And so what we're actually looking at is a massive price reduction and a massive difference in what the buyer at the end of the day is seeing. Because at the end of the day, yes, they're looking at what do they have as a purchase price. What they're really looking at the end of the day is what are they actually looking at from a cash flow standpoint, to your point.
Always cash flow.
Right.
Yeah. $150, that's groceries.
Yeah, $1,000 is
Thousands.
groceries and a different lifestyle,
Yeah.
right? And so to your point, we were yelling from the mountaintops over the COVID pandemic of this is really cheap money. You need to absolutely go out and take advantage of it. And that's what we saw a lot of people do, right? While a lot of people were scared by the news, a lot of people took advantage of all of what was happening with the cheap money. And
Mm-hmm.
right now, we're seeing buyers' ability to actually get more affordable rates just by having this temporary buy down available. And so right now it's a really good opportunity for somebody to get in because at the end of the day, we're going to have lower rates. And as soon as we get back into like the true 5% range, there are going to be a lot more buyers out there and that competition is going to go through the roof.
It's going to drive prices back up again.
Right.
Yeah.
And so the educated buyers, they're not letting the holiday season slow them down when it comes to their home buying.
Absolutely not. You want to be in the least competitive market possible. So that said, a well-priced home in Austin, Texas is still going in multiple offers. I know because I have clients in the middle of a multiple offer right now. So they're buyers on a multi-million dollar property, and smart buyers are not waiting for anything. They are betting on the long run of the market. They are betting on the fact that money is available and the price is the price, and they would rather have less competition than more competition and lay their head on the pillow of their new place. So yeah, the smart buyers are still buying right now, and they're just really understanding, to your point, how to make their money work for them and put the real cost of borrowing at their advantage.
And we've talked about it in episodes past, right? What we've talked about just now with the temporary buy down, with the permanent buy down, it's absolutely not the only way to reduce the cost of home ownership. We've talked about that principal reduction strategy in the past, right?
Mm-hmm.
That same 25 grand could get applied in that way. And a lot of the time that actually will save them more money. And so at the end of the day, it comes down to somebody needs to buy or sell a home and move. At the end of the day, unless you're in the real estate industry, unless you're in finance, trust the professionals. Make sure you get somebody that's really looking out for you as opposed to trying to get another deal in the pipeline.
Oh, absolutely. 100% all day, every day. Thanks for saying that, Mark. I appreciate it. All right. Well, with that said, the Austin market seems to have leveled off quite a bit from where it's been in all of the best ways possible. And I'm excited as we head into the holiday season, if you will. And Mark, with that said, again, I am thankful for you and all the great work that you do. And thanks so much for educating people and breaking it down and simplifying how money works when it comes time to borrowing for real estate.
If you've got any questions, I am an open book. I'll be happy to help you.
All right. Thanks so much. Well, with that said, my name is Jennifer Goodman. I'm a realtor here in Austin, Texas.
And I'm Mark Kretsky with Movement Mortgage here in the DFW. Enjoy your Thanksgiving.
Happy Thanksgiving, everyone.